Hi everyone, and thank you for joining us at Mirai Asset Mutual Fund. Life is uncertain. In this uncertain life, we constantly strive to attain a balance. When it comes to investments, particularly in debt mutual funds, that balance between risk and reward can be achieved through a strategy known as barbell strategy. So imagine a wheel set which has two pairs of wheel at both the extremes. It is joined by an axle or a rod. The aim of this wheel set is to provide a balance to the train. It goes through curves and it goes through various movements, but the slanted position of the wheel set provides that balance much required to the train. So drawing similarities with the wheel set, in a barbell strategy, at one end we have short-term maturity papers, at the other end we have long-term maturity papers. When they both combine, they strive to provide a balance to the portfolio due to the diversified nature of the same, and there is a possibility of having a lower risk appetite. Let's know more on the same with our fund managers, Mr. Basant Bafna and Ms. Kruti Chheta. Thank you for joining us. Mr. Basant Bafna is a senior fund manager with Mirai Asset Mutual Fund. He is currently managing Mirai Asset Ultra Short Duration Fund, Mirai Asset Money Market Fund, Mirai Asset Short Term Fund, Mirai Asset Corporate Bond Fund, and Mirai Asset Banking and PSU Fund. He has an overall experience of over 12 years. In his previous stint, he was Chief Dealer and Assistant General Manager at Export-Import Bank of India. Welcome, Mr. Bafna.
Happy to be here.
We also have with us Ms. Kruti Chheta, who is managing Mirai Asset Savings Fund. She has an overall experience of over 8 years. 5 years have been with Mirai Asset Mutual Fund. She has been a fixed income analyst and a fund manager with the company. Welcome, Kruti.
Thank you, Tanya.
So continuing with the barbell strategy, Basant, what's your take on this?
Thanks for your question, Tanya. As you've aptly covered in your initial remarks, a barbell strategy would broadly include positions in two extreme ends of the yield curve in the segment in which the respective fund is operating. So one part of the yield curve would be the longer end of the yield curve, which would provide opportunities for capital gains as and when either the yield sort of comes down or the spreads narrow. The other end of the yield curve, which is the shorter end of the yield curve, broadly provides stability in returns and accruals. So that's broadly a barbell strategy.
Sure. So Kruti, coming to you, what are your views on the barbell strategy?
Thanks, Anya. So you've rightly introduced, and Basant has given an explanation of barbell strategy is. I would just like to highlight a point over here that every strategy has a timing, right? And barbell strategy also is about the timing when it will work. So it could work in a timing which is where there is a lot of uncertainty or a chaotic situation. In this strategy, what we are trying to do is we are trying to hedge by the longer, where we know that there is an end result that is going to be there, but we are uncertain of the time when we are going to reach there. So we capture that at the longer end, and at the shorter end what we are doing, we are trying to avoid the interim volatility that is there or the damage that could be done during that time. So it is a perfect and a unique mix where you are aggressive and at the same time you are paranoid about the situation. So moreover, it's giving a good mix of both the situations and where you want to be safe. And what happens is that in this strategy, when you are at the longer end and when the tide has turned, finally the uncertain times have passed away, you can either exit with it on an extraordinary gain on your portfolio, and if things go bad, then you have hedged your risk and there is a limited risk with this strategy. So this mainly it could work more in the uncertain times than a normal situation that you foresee.
Sure. So the mechanics of a barbell strategy, that at one end you have an extreme short durations, short maturities, and on the other end you have long duration maturities. That sort of plays out potentially well for a balanced approach and a diversified approach, especially for an investor's portfolio, right? Basant, my next question is for you. Globally, interest rates are at peak. Some economies are pressing on a pause button. A few other economies are still hiking their interest rates. So in this background and this global backdrop, how do you see barbell strategy working?
Tanya, global yields have seen significant volatility as compared to domestic yields. if you look at one of the reasons and one of the major reasons why this divergence exists is because of the divergence between central bank commentary and what markets perceive. So if you look at the US Fed continues to echo its views that rates may remain longer, higher for longer, but markets are still perceiving a rate cut as early as Feb next year. The other, issue broadly stems from macroeconomic fundamentals. Now, if you look at the US economy is significantly heated at the moment with low unemployment close to all-time lows. The job availability is significantly high as compared to pre-pandemic levels, and inflation is significantly high. So if you look at core inflation, core is at 4.8% as against their overall inflation target of 2%, right? If you look at other economies like Europe, it remains significantly divergent in terms of unemployment. So unemployment there is close to 6.5%. But if you look at their inflation, the inflation problem remains, right? If you look at other economies like UK, problems are similar. Broadly speaking, the major reasons for the volatility is the divergence between central bank commentary and markets, and the macroeconomic fundamentals and their divergences against targets. But essentially, if you look at how markets are perceiving, markets are talking about rate cuts. So broadly speaking, we are close to the peak, and it's about when the rate cuts happen rather than whether it will happen or not. In this light, if you look at a barbell strategy, what that essentially does is that in times of volatility, and as Kruti mentioned aptly, in times of volatility, it sort of insulates you from market volatility and gives you stability in returns by way of accruals. And as and when the market reverses, it gives you the possibility of generating alpha by way of capital gains as and when the interest rate cycle reverses.
While Basant has given his view on the bubble strategy in the backdrop of global environment, Kruti, what are your views, if we'll say, on the bubble strategy in the backdrop of domestic environment?
So, as Basant has aptly mentioned, that global there is a lot of uncertainty, and it is about that when the rate cut will happen rather than the question about whether the rate cut is happening or not. So, in domestic perspective, if we go to see right now, the dynamics are very stable from India perspective, and the only interim volatility that we see is from the inflation. But otherwise, if we go to see broadly India perspective, everything is much more stable. And if we see our yield curve today, it is flat. A flat yield curve indicates that there is going to be a rate cut where the longer end is pricing in a rate cut, and your shorter is acting to the current volatility. So it's a perfect example of a situation where you are expecting a rate cut in future. So barbell could work in such a situation where you get invested in your target maturity, the target investment horizon that you have, and to avoid the interim, you stay hedged on the shorter end so that you avoid the volatility in the interim. And from a perspective of a domestic also, right now we know that at the end of the tunnel there is a light. It's just when rather than whether yes or no.
Right. So seeing from a global perspective and then seeing India's macroeconomic situation, this time looks apt for looking at something like a bubble strategy, right?
Probably.
So yeah, the outlook overall remains positive, but we also need to consider the fact that there may be some uncertainties along the way. Globally, I think there are a lot of macro data points that are yet to emerge, and that may drive policy making going forward. Domestically as well, there are a lot of uncertain data points. So if you look at monsoons, while monsoons have covered up significantly, but still the spatial distribution remains uneven. If you look at the sowing data as well, while there is a lot of coverage that has happened, in some segments like pulses, we're still lagging. While government has adequate buffers, but there might be some volatility owing to monsoons and inflation, and that might come into inflation prints as well. So we are expecting the next two inflation prints to be on the higher side, and that may witness some volatility in yields as well. But rightly said, from a long-term perspective, I think we are constructive on duration as well as yields.
You mentioned duration, Basant. So here I'm just thinking out loud. Is combining barbell strategy with duration possible? If so, how could one look at it?
When you look at a barbell strategy, you generally combine two factors. One is credit spreads and the second is the interest rate outlook. Now, if I look at the credit spreads, I'll probably divide it in two parts. The first part is on the longer end of the curve and the second part is on the shorter end of the curve. So if you look at the longer end of the curve, the 3 to 5 year part of the curve looks significantly attractive to us, primarily because it's, the spreads are close to the long term averages and higher than the short term averages or 3-month averages. Now, that's one of the reasons. But if you look at the shorter end of the curve, the 6-month part of the curve probably has around 65 basis points worth of spread over overnight rates, and the 1 year part of the curve has a spread of close to 95 basis points as compared to the 3-month part of the curve, which has around 45 basis points. So the curve remains significantly upward sloping in the shorter end. In this strategy, we'd like to combine the best of both worlds. So look at the part of the shorter end of the curve which remains attractive, and look at the longer end of the curve. So if you look at the Mirae Asset short-term fund, it combines the best of both worlds. So in the shorter end of the curve, we have weights in the 2024 segment, which is broadly the 1 year segment, and in the long duration part of where the short duration fund operates, we are in the 5-year segment, which is broadly the 2028 segment. But as you aptly mentioned in your initial remarks, you have wheels on both sides, but you also have an axle to support. So from that perspective, we have some weight in the 2026 segment. So broadly, that's how we are looking at the Mirae Asset short-term fund. But coming to the second part of the conversation on the interest rate outlook, just to add with the credit spreads, the interest rate outlook remains constructive, and that's how the barbell strategy works in this situation.
So you mentioned an example of Mirae Asset short-term fund using a combination of barbell strategy as well as duration. Are there any more portfolios of funds that you look at following a similar strategy?
Yeah, sure. So in the Mirae Asset Banking and PSU Debt Fund, along with the core positioning in the 3-year segment, we have taken selective exposures in the 10-year as well as in some instances 15-year exposures as well. If I look at the Mirae Asset ultra short duration fund, there as well, along with the shorter end of the curve, which is basically in the 3 to 4 month segment, we've constructed one wheel of the barbell, and we've started constructing the other wheel of the barbell in the 1 year segment, and we'll look at adding further positions as spread evolve there.
So before we take remaining couple of questions, I would like to thank you both for such an insightful discussion. We started with explaining what a barbell strategy is. We saw it in the backdrop of global environment. We saw it in the backdrop of domestic environment. Then we saw that we understood from you whether can we combine a barbell strategy with the duration, and you gave us a practical example of how we are looking at enough funds, applying that enough funds. So now my question is that investors often look at, they often align actually a fund's investment, a fund's duration with their investment horizon. Is this a correct way to look at debt funds?
So it really depends on the investment horizon of the investor along with the risk appetite of the investor. So if the investor is aggressive, meaning his risk appetite is higher, he could look at having higher duration as compared to his investment horizon. I'll just give you an example. So if, say for example, the investment horizon is 3 to 5 years, an investor having an aggressive investment horizon along with the interest rate outlook. So for example, if the interest rate outlook is for yields to come down over the next, say, 6 to 12 months, the investor could look at a higher duration product, say for example a 8 to 13 year GSEC ETF, which would have a macular duration of between, say, 6.5 to 7 years, or perhaps could look at a banking and PSU debt fund or a corporate bond fund for that matter, and realize that alpha as and when the interest rate cycle reverses. Now, if the investment horizon, say for example, is 1 to 2 years, right, the investor could look at a higher duration product, but the investor should be aware that there are risks associated with such strategies, right? And then if the rate outlook or the volatility in between emerges, then the returns might be impacted accordingly. But if the investor wants to remain passive and wants to realize the returns based on the YTM and based on the duration, then the investment horizon should align with the duration of the product. Looking at the shorter end of the yield curve, say for example, if the investor has a 3 to 6 month investment horizon, and if the investor wants stability in returns and wants to remain passive, could look at say an ultra short duration category, or for that matter a money market category. But within the same investment horizon, if the investor is looking to generate alpha, could perhaps look at the low duration category.
So coming to the last question, Kruti, this one is for you. So is there anything else that investors should be looking at, while they are investing in debt mutual funds?
So apart from the investment horizon that Basant mentioned, that one needs to be cognizant that what is the tenure of my investment and what is my risk appetite. Now risk appetite, one is the tenure, that's called the typical interest rate risk, and the second is the credit risk that can be taken. So when you are going for a fixed income investment, it's perceived that you're looking for a regular and a low volatility return, right? So there could be some products or the offerings that could be higher on the risk. Not that you should stay away from that. If your risk appetite is there, you should go into that products, but an investor should be cognizant of what they are investing in, and whether it is meeting their investment goal or not. And this maps it to that you have to look at your investment horizon and you have to look at the risk appetite that you are investing into.
Sure. Thank you, Basant. Thank you, Kruti, for such an insightful session. Debt is often viewed as a very complicated and a complex subject, but we discussed a barbell strategy. We discussed some other, insights, what it could help investors in choosing right debt mutual fund for them. So thank you so much for your valuable insights and time.
Thanks, Tanya, for hosting this.
Thank you, Tanya. It was a pleasure.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.